everybody, and welcome. My name is Al Castellanos, and I represent Premier Insurance Contracts. In this presentation, we'll take a look at some general financial planning concerns. While there is not such a thing as a one-size-fits-all financial plan, this overview should assist you in thinking about your own needs. There is a lot of ground to cover, even when we're talking about an overview. Here are some of the topics that we're going to be touching on. We're going to talk about setting goals. Doing so is really the first step towards developing any type of financial plan. Then we'll discuss constructing a budget. And we will also talk about creating an emergency fund. Then we're going to touch on insurance protection. Additionally, in many cases, you may need to incorporate credit into your financial plan. So we'll discuss some credit fundamentals. We'll also talk about some basic investment concepts. And we're going to make sure we understand pre- or after-tax allocations along with tax-deferred growth and see how that can help you pursue your goals. Goals such as saving for college or maybe planning for your retirement. Now, last but certainly not least, we'll look at the rudiments of estate planning. So let's get started right away. One of the first steps in financial planning is setting goals. When you set goals, you are defining your dreams for the future. Some of your goals may be things that you want to do in the not so distant future. Like, for example, pay off your credit card debt or maybe buying a new car. Other goals may be more distant. Do you want to buy or maybe build a new home? Would you like to start your own business? Would you like to pay for college for your child or your grandchild? Are you considering retiring early? You see, your goals are the foundation of your financial plan because you need to know what you want to accomplish before you can begin saving or investing. Once you have identified and prioritized your financial goals, you can develop a clear-cut savings or investment strategy that can help you turn your dreams into a reality. Making your goals as concrete as possible will help you focus on what's really important. A goal that's well defined will be easier to visualize and easier to stick with. Now, in order to set clear-cut goals, you can use the SMART technique. SMART is an acronym that stands for specific, measurable, attainable, relevant, and timely. A goal that's specific is one that's clearly defined and described in detail. Precisely, what do you want to accomplish? I want to save for my child's college education. That is not a specific goal. But if you say something like, I want to save the cost of 4 years at Texas Tech University, by the time my daughter turns 17, that's a clearly defined goal. With a goal that's measurable, you should be able to track your progress and clearly know when you have reached it. For example, I want to retire early is not a measurable goal. But if you say, I want to retire by my 55th birthday, that is a goal that has a definite endpoint. An attainable goal is realistic and reachable. Goals can be challenging, but you should have a fair chance of achieving them. I want to save 1 million in 5 years. That is not an attainable goal for many people. But if you have a goal like, I want to save 1 million in 30 years, that may well be an attainable goal. Now, a relevant goal is one that makes sense to you and that reflects your specific needs and your values. Goals that are relevant are goals you will be excited about because they will be important to you. For example, I want to save $25,000 for a down payment so that I can own my own home. That's an example of a goal that might be relevant. Now, you must also be able to set a time frame or a deadline for reaching your goals. I want to pay off my credit card debt by the end of next year. That is a goal that has a clear deadline. Writing down and prioritizing your goals is an essential first step towards putting a financial plan into action. The first part of putting any financial plan into action requires you to control your flow of money. That's part of what a budget is all about. You see, a budget tracks your income and expenses and helps you direct the flow in the way you want it to go. In order to construct a budget, first you need to account for all of your income. This includes things like your paycheck plus any income you might have from other sources, such as a rental income or any type of government benefit that you are getting, or interest on money you have in the bank, or maybe some investment income. Well, once you have that amount, from that, you need to subtract your expenses. Expenses can be broken down into two categories. Fixed expenses are those you pretty much have to pay, such as rent, or a mortgage payment, or a car payment, or insurance, utilities, groceries, and basic clothing. On the other side, discretionary expenses are more optional items, such as eating out, or entertainment, or gifts, and also includes vacations. It can be difficult to get a handle on many of these numbers, especially in the expense items. You may want to keep track of them for a while, either with a paper and pen or on a computer software program, and you find out how much you are spending. And remember, not all of your expenses occur on a weekly or a monthly basis. Some expenses are seasonal, like holiday gifts. Other expenses are occasional, like car repairs or getting a cavity filled. It may take several years of tracking some expenses to get a really good idea of what you spend on average per month or per year. Now you need to subtract your average expenses for a given period, a month or a year, from your income for that same period. Now this is the important question. Is there a positive number left over? If so, you are in the black, or you are running a surplus. Now, a surplus can be converted into savings or into an investment for the future. But if you get a negative number, that's bad. You are in the red, or you are running a deficit. You are spending more than what you are making. The only thing that's going to change that equation is either increasing your income, perhaps getting a second job, or decreasing your expenses. And you always need to start with the discretionary expenses, the fun stuff. Those are the easiest to reduce initially. So let's look at the bright side. You are running a surplus. One of the first things that you want to do with that surplus is to create an emergency fund. An emergency fund is money that's readily available to meet unexpected expenses. It's really the foundation for any successful financial plan. Without money to fall back on when an unexpected expense crosses upon you, you may be forced to tap on savings that you have earmarked for retirement or college or another savings goal. But if you have an emergency fund, it will be much easier to handle a job loss or temporary disability or any other event that might prevent you from saving for the future or even tempt you to pile up debt. How much should you have in your emergency fund? A popular rule of thumb is that you should have an emergency fund equal to 3 to 6 months of your living expenses. But should you have 3 months, 4 months, or 5 months, or 6 months worth of your expenses? The amount you should have depends on many factors. First, how stable is your income? Do you work in an industry where there are layoffs? Where layoffs are very common? Or are you in a growing field? Do you have an adequate health and disability insurance? Do you have any other assets that you could tap without a penalty in case of an emergency? Where you keep your emergency fund is also important. In a jar is probably not the best idea. You'll want to keep your money in an account where it's readily available, but you also want to receive as much high return as possible. Rarely do you write one check equal to 6 months or even 3 months worth of expenses. So you may only need part of the fund in something as liquid as a savings or a checking account. The balance of the emergency fund can be held in something getting a better return, but that you can still access in 1 day or 2 days. Another important part of financial planning is identifying and managing the potential risks that can impact your finances. The value of insurance is that it is a cost-effective way to mitigate or share the frequently overwhelming cost of various risks. Now, we're going to spend a few moments looking at the types of risks that you might want to insure against. What used to be called health insurance has actually been replaced by healthcare plans. Most plans provide basic coverage for common medical expenses such as doctor visits or preventive care or diagnostic tests, hospitals and extended care, emergency services, and prescription drugs. Auto insurance has two main components: liability insurance and insurance for property damage. Liability insurance provides compensations to persons who would be able to sue you for personal injuries or medical payments or loss of earnings or damage to their property. Property damage insurance includes collision and comprehensive coverage, which compensates you for damage to your car caused by another auto or by such things as fire, theft, and vandalism. Life insurance offers income replacement to your survivors. It can provide an income tax-free death benefit and can be used to pay for funeral expenses and even medical expenses of a last illness. For the majority of us, our most valuable asset is our home. The most common type of homeowners policy in use today covers a variety of risks that can cause damage to your home and personal property. It covers damages for medical payments, for injuries to occupants, and to persons injured by accident while in your home, and loss or theft of personal property. Liability insurance is often your last line of defense against potentially devastating claims for things over which you may have little or no control. It's often called umbrella insurance because it's carried over all other liability insurance and usually adds $1 million or more in extra coverage to your homeowners and automobile liability policies. Coverage is provided for you, your spouse, and any relatives living in your household and insured by your primary policies. What if you couldn't work for an extended period of time because of an injury or illness? How would you replace those earnings? Who would contribute to your retirement savings account or educational funds? Disability income insurance benefits can be used to preserve your independence, maintain your lifestyle, give you time to recover, provide a chance to retrain for another job if necessary, and conserve your assets and savings for you and your family. What is long-term care insurance? It's private insurance that pays benefits if you need extended care, such as nursing home care, Like any other type of insurance, long-term care insurance protects you against a specific financial risk. In this case, the chance that the need for long-term care will wipe out your life savings. Okay, so you have established an emergency fund and you have insured yourself against certain risks to your financial security. And to meet your normal expenses, you have planned a budget. But sometimes you need more funds than your budget might cover at the moment, and that's where credit comes in. Now, a word of caution here. Do not rely on credit to cover your normal living expenses. If you do so, you could be heading down a path that may lead to financial disaster. If you are using credit to pay for normal living expenses, it should be because it's convenient to do so, not because you don't have those expenses planned for in your budget. Merriam-Webster's dictionary defines credit as the provision of money, goods, or services with the expectation of future payment. When it comes to financing big ticket items, such as college education, or a home, or even a car, most of us will need some sort of loan. And there are many times, like shopping for Christmas or going on vacation, when it's just more convenient to use credit. In this case, in the form of a credit card to make all your purchases. So, how do creditors decide to grant credit? Well, it depends on how well you meet the 3 C's. Creditors will want to know if you have the capacity to repay the credit they grant you. They'll want to know about your income and your expenses. So, okay, once a creditor determines that you can repay a loan, the next question is, will you? This is a matter of your credit character. To measure this, they'll look at factors that measure your stability. How long have you had the same job and lived in the same place? And if you have used credit before, they'll also want to look at your repayment track record. Do you pay your bills on time? Particularly for loans of larger amounts, like a car loan or a home mortgage. A creditor might also want some collateral. Collateral is tangible property that secures the credit extended to buy it. If you default on repaying the loan, the creditor will legally be entitled to take possession of the property as a form of compensation. Creditors determine your credit worthiness primarily by examining 3 documents. The credit application you fill out with a potential lender will ask you for your personal information. It would also ask you about your income and its sources, and may ask about your recurring expenses and other debt. Your credit report will give a potential lender a wealth of information about your payment history, and your credit score comes from a statistical formula that analyzes the information on your credit report, compares your profile to thousands of other similar profiles, and produces a 3-digit number that predicts your level of future credit risk. The information gleaned from these 3 documents may not only determine whether you can get credit, but also what interest rate and other terms you are offered. When you are granted a loan or use a credit card, you create a debt. Some debt may be small, a minor purchase on a credit card, and may be repaid quickly. Others are large, a home mortgage or a student loan, and that may take years to repay. How well or poorly you meet the repayment schedule for the debt will have an ongoing effect on your credit history and on your credit score. Debt may be divided into 2 basic types: secure debt and unsecured debt. Eventually, you may have some of both. Secured debt is debt backed by a lien or some type of collateral. Examples include a mortgage or home equity loan, a car loan, or a secured credit card. Unsecured debt does not have in place a lien on any real or personal property to secure it. Examples of unsecured debt are personal installment loans, student loans, and most credit card accounts. When you think about taking on a debt, there are several important considerations. The amount you borrow obviously will have a big impact on the size of your payment, no matter what term, and by that we mean the length of time you have to repay it or the interest rate that you have been charged. You need to consider that within a review of your budget. When looking at an installment loan, the term of the loan is the length of time you have to repay it. Generally, larger loans have longer terms. While longer terms help make your monthly payments smaller, remember that a longer term also generally results in a higher total interest payment over the life of the loan. Revolving credit accounts, such as credit cards, do not have a fixed term for repayment. Instead, a certain percentage of the current balance due is expected each month. The smaller that percentage is expected to be, the longer it can take to repay the entire balance. The interest rate you are charged on a debt also affects the total interest you'll pay on the loan. The higher the rate, the greater the interest charge will be. Now that we have talked about using credit and the potential for accumulating debt, let's talk about investing and the potential for accumulating wealth. Do you associate investing with speculating or gambling? Do you think of it as betting on what the market will do, or trying to time the market in order to make a quick profit? Or do you think of investing as a more of a long-term, methodical saving effort to build for the future? Well, it's a little of each. Investing involves taking a certain amount of risk, and it also involves the desire to multiply your money over time. Done properly, investing is a carefully planned and prepared approach to managing your money with the goal of accumulating the funds you need. And the planning your investment strategy is about discipline and patience. When it comes to investing, there is a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk. Or stated another way, the less risk an investment has, the lower the potential for a return. The investment plan that's right for you depends largely upon your level of comfort with risk, what's known as your risk tolerance. You can't completely avoid risk when it comes to investing, but it's always possible to manage risk. There are two questions that determine your risk tolerance. First, how comfortable are you personally with risk? This is a subjective measure, and it depends on many factors, including your financial goals, your life stage, your personality, and your investment experience. Some investors are comfortable with a high degree of risk. Others cannot tolerate very much at all risk. And a lot of people fall somewhere in between. The second key question is, how well is your investment plan set up to handle potential losses? The more resilient your overall plan is when faced with any potential losses, the more risk it might be able to take on. For example, time can be a powerful ally. The longer you're going to be invested, the more flexibility your investment plan might have to survive setbacks along the way. There are several key terms you need to understand when planning your investments. These three words are probably familiar, but they have very specific meanings when it comes to investing. We all know we want our money to grow, right? When it comes to investing, growth means that an investment has the potential to grow in value. If that happens, you might be able to sell it for more than you paid for it. Income comes from regular payments of money or payment of interest on a savings account as income. So is interest on a certificate of deposit, interest paid by a bond, and dividends paid by a stock, all of that is income. Stability, the third potential objective of an investment, refers to protecting your principal. An investment that focuses on stability concentrates less on increasing the value of that investment and more on trying to ensure that it does not lose value. As much as we might like to, we can't have it all. There is a relationship between growth and income and the stability of your investment. The more important one of these areas becomes, the more you may have to trade off in terms of the other two. The key is to tailor your investments according to what you want them to do for you, and to balance stability, income, and growth so that you maximize your overall returns at the level of risk that you are comfortable with. Before we talk about some specific investment vehicles, let's first mention some important tax considerations. Your employer may allow you to cover some ongoing expenses with pre-tax dollars. Pre-tax dollars are funds that are taken from your pay before certain taxes on your pay are calculated. For example, your federal income tax. Your taxes are then calculated on your remaining pay, and this creates a tax savings for you. For example, if you're in a flat 22% tax bracket and you are allowed to buy a $100 commuter pass with pre-tax dollars, the pass really only costs you $78 in after-tax or take-home pay dollars. The result can be a lower out-of-pocket expense for you. Some opportunities, if your employer offers them, where you might cover expenses with pre-tax dollars, may include paying your health insurance, disability insurance, dental insurance, and vision insurance premiums. Your employer may also allow you to contribute pre-tax dollars to a flexible spending account, an FSA, for either medical expenses or dependent care expenses. With an FSA, you contribute pre-tax earnings to the plan and submit qualified expenses to the plan for reimbursement. And as mentioned above in our example, your employer may allow you to pay certain qualified commuter or parking expenses with pre-tax dollars. Your employer may also offer a retirement plan, like a 401k plan, or a 403b plan, or a 557b plan. What these plans have in common is that they allow you to elect to contribute a percentage of your earnings on a pre-tax basis. These plans are intended to be used to save for retirement, and they offer advantages that go well beyond the fact that you get to fund them with pre-tax dollars, as we'll see later. Another consideration is that some specific investment vehicles allow for tax-deferred growth. Whether you are investing pre-tax or after-tax dollars, tax-deferred growth basically means that you won't owe any taxes on the growth of that investment until you withdraw funds from the account. And in certain cases, qualified withdrawals from these investment vehicles may be tax-free. Some examples of investment vehicles that qualify for tax-deferred growth are 529 college savings plans and prepaid tuition plans. A 529 plan is funded with after-tax dollars. Your investment grows tax-deferred until you withdraw the funds, and at that time, if the funds are used for qualified educational expenses, the funds may be withdrawn tax-free. Both traditional and Roth IRAs also allow tax-deferred growth. In the case of traditional IRAs, your contributions are made with after-tax dollars, but they may, if you qualify, be tax-deductible on your federal income tax return. This is important because tax-deductible contributions lower your taxable income for the year, saving you a lot of money. And the funds in a traditional IRA are sheltered from federal income tax until withdrawn. As for Roth IRAs, if you qualify on the basis of your income to contribute to one, your contributions are made with after-tax dollars and are not tax deductible. But the good news is that if you meet certain conditions, your withdrawal from a Roth IRA, including any investment earnings, will be completely free from federal income tax. With most of the investment vehicles mentioned, for example, 401k plans, IRAs, and 529 plans, a 10% penalty tax applies if you take distributions before a certain age for a non-qualifying purpose. Let's illustrate the value of tax deferral. Let's assume you have $20,000 to invest. You put $10,000 into a taxable account that earns 6% per year and use a portion of these assets each year to pay taxes attributable to the account's earnings. You put the other $10,000 into a tax-deferred account that also earns 6% per year. Assuming that a tax rate of 24% applies, in 30 years, your taxable account will be worth a little bit over $38,000. In that same time, your tax-deferred account will have over $57,000. Of course, the funds in the tax-deferred account might be subject to federal income tax when withdrawn. But even if you took the entire amount in the tax-deferred account as a lump sum distribution after 30 years and paid tax on the full amount, you will still come out ahead in this example. At a tax rate of 24%, you end up with $43,000. Again, a note of caution. depending on the specific tax deferred vehicle, an additional 10% penalty tax could apply if you took distributions before a certain age or for a non-qualified purpose. Additionally, these illustrations assumes a fixed annual rate of return over the 30-year period. Of course, in real life, the return on a portfolio will vary over time according to market conditions. That is particularly true for long-term investments. Okay, now that we have some understanding of investing either pre-tax or after-tax dollars in vehicles that allow tax-deferred growth, let's look at a couple of things you might be investing for. For most people, the two biggest life events they need to save for are college education for their children and funds for their own retirement. Let's spend a few moments talking about saving for college. Perhaps your potential Harvard graduate is still in diapers. But given the cost of college, you'd be smart to start a systematic college savings plan now. And one of the options available for saving for college is a 529 plan. Because this savings vehicle offers the advantage of tax-deferred growth, it should be the cornerstone of any college savings program. So what is a 529 plan? A 529 plan is a savings vehicle that is governed by the federal government but offered by the states. Anyone can open a 529 plan. There are actually two types of 529 plans: college savings plans and prepaid tuition plans. A college savings plan, which is the more popular type, is an individual investment account to which you contribute money. Your money is allocated to your choice of one of the plan's pre-established investment portfolios. They normally range from very conservative to very aggressive in the amount of risk. Returns are not guaranteed, but funds can be used at any accredited college or high school. Almost every state offers a 521 college savings plan, and you can join any state's plan. The second type of 529 plan is a prepaid tuition plan. As its name suggests, when you join this type of plan, you actually prepay your child's college tuition, but you do it at today's prices. The contribution you make today is generally guaranteed to cover a certain percentage of college tuition for tomorrow. However, you are typically limited to your own state prepaid tuition plans, and your child is limited to the colleges that participate in the plan, generally in-state public colleges. The main benefit of a 529 plan is that your contribution grows tax-deferred and earnings are completely tax-free at the federal level when they are withdrawn to pay the beneficiary's qualified education expenses. Note that withdrawals that are not used for qualified expenses are subject to a federal income tax as well as a 10% penalty tax. Additionally, there are fees and expenses associated with both types of 529 plans. Finally, it's important to note that if you are considering a 529 plan, it generally makes sense to start by checking to see if there is a plan offered by your state, since that plan might provide favorable state tax benefits to residents. And you should always read the issuer's official statement carefully and consider the investment objectives, the risks, the charges, and all expenses associated with a 529 plan before you invest into any one of these plans. The other major life event you need to save for is your own retirement. Even if you feel you are too far away from retirement to start thinking about it, it's important that you start planning now. Many people assume they can hold off saving for retirement and make up the difference later. But this can be a very costly mistake. The further off your retirement is, the more time your investments have the potential to grow. Waiting too long to make it will make it difficult to catch up, and only a few years can make a big difference in how much you'll accumulate. For example, invest $3,000 every year starting when you are 20 years old, and if you retire after age 65, you will have accumulated almost $680,000, assuming a 6% annual growth rate and no tax. If you wait until age 35 and start saving $3,000 annually, you'll accumulate only $254,000 with the same assumptions that we mentioned before. So this does not mean there is no hope if you are 50 years old and you haven't set aside anything for retirement yet. It just makes it all the more important that you implement a plan today. Of course, the numbers that we're giving are just illustrations to make a point, but each case is different. Before you can start planning for your retirement, you need to ask yourself 3 basic questions. What kind of retirement do I want to plan for? When do I want to retire? How long will retirement last? Close your eyes for a second and picture your own retirement. Whether you see yourself on a golf course or a yacht or a hammock or simply in your own living room, most of you probably imagine some degree of financial independence. To a large extent, maintaining financial independence in retirement depends upon the lifestyle we want. And you have thought about when you like to retire? It's important because the earlier you retire, the shorter the period of time you have to accumulate funds, and the longer the period of time those dollars will need to last. Although you can retire anytime, most people wait until they are eligible for Social Security. You can't start receiving Social Security benefits until age 62, and the earliest you can receive full Social Security retirement benefits is age 65 to 67. And that depends on the year you were born. Also, you are not eligible for Medicare health coverage until age 65. So if you want to retire before then, you want to plan for private health insurance. As we have just discussed, the earlier you retire, the longer the period of time your funds will need to last. But how long should you plan on your retirement lasting? Keep in mind that life expectancy has increased at a steady pace over the years and is expected to continue increasing. The point that I want to make is that for many of us, it's not unreasonable to plan for a retirement period that lasts for 25 years or more. One of the best ways to accumulate funds for your retirement is to take advantage of special tax advantage retirement savings vehicles. Some of these, such as a 401k plan, can be a very powerful savings tool. The reason for that is because your contributions come out of your salary pre-tax, reducing your current taxable income, and also grow tax deferred until withdrawn. And 401k plans can include employer matching contributions. It's a form of free money, which should make them your first choice in saving for retirement. You may also be able to make Roth contributions to your 401k plan. Since they are after-tax and not pre-tax contributions, Roth 401k contributions do not provide you with an immediate tax savings, but they allow you to make withdrawals completely free from federal income taxes under certain circumstances. Traditional IRAs, like 401ks, feature tax-deferred earnings growth and can lower your current taxable income if you qualify to make tax-deductible contributions. And like a 401k, funds in traditional IRAs are not taxed until they are withdrawn. Roth IRAs, like Roth and 401ks, do not permit tax-deductible contributions, but they allow you to make a completely tax-free withdrawal under certain conditions. Since these vehicles are intended to help you save for retirement, a 10% additional penalty tax applies if you take a withdrawal before reaching age 59 and a half, unless some exception applies. Any complete financial plan should also involve estate planning. Let's look briefly at some of the basic concepts you need to understand to achieve your estate planning goals. Here are some of the topics we'll be reviewing. First, we'll look at an intestacy and why you may want to avoid it. Next, we'll consider the importance of wills and trusts in estate planning. Then, we'll discuss incapacity and what you can do to prepare in case incapacity should strike. Let's say you die leaving $50,000 in a savings account. Who does the money go to? Without instructions from you, the money will go where your state's intestacy laws directed to go. Intestacy laws vary from state to state, but here you see a typical pattern of distribution. 50% of your property goes to your spouse and 50% to your children. Remember, it may be different in your particular state. The biggest issue with intestacy is that your actual wishes are irrelevant. Without an estate plan, regardless of your wishes, your estate will be divided between your spouse and your children. There are many potential problems with allowing your property to pass by intestacy. Intestacy can be particularly problematic for unmarried couples, since intestacy generally will not include an unmarried partner in the distribution of property. There is a very simple way to avoid intestacy, and that is if you create a will. A will is probably the most vital piece of anyone's estate plan. A will is a legal document in which you direct how your property will be dispersed when you die. It also allows you to name an executor who carry out your wishes, which are stated in your will. In addition, your will lets you name a guardian for your minor children. You can use your will to accomplish other estate planning goals as well, such as tax planning. To be valid, your will must be in writing and signed by you. Your signature must also be witnessed. These requirements are important because if you are not careful, your will may be invalid. So, see an estate planning attorney to take care of this for you and avoid any do-it-yourself solutions. Financial planners can also help you in guiding you in terms of all the elements you need to take into consideration. Finally, let's talk a little bit about incapacity and why and how you should plan for it. Incapacity describes a condition in which you are legally unable to make your own decisions. Think for a moment what might happen if, for example, you were to become the victim of an accident that puts you in a coma for several months. How will your doctor know what medical treatment you would want or not want if you can't speak for yourself? How will your personal business be transacted? If no one is authorized to sign documents for you, how are you going to run your business? What would happen is this. Someone would have to go to court and get legal permissions to do things for you. And that person, who's called a guardian, and is usually a close family member, such as your spouse or a child, would have to go back to court every time permission is needed. As you can imagine, this might be quite burdensome to the guardian. Further, without any prepared instructions from you, your guardian might have to make decisions that would be different from what you would have decided. Fortunately, these situations can be avoided with proper planning. Healthcare directives allow you to leave instructions about the medical care you would want if conditions were such that you couldn't express your own wishes. And property management tools ensure that you can have your financial affairs taken care of for you in the event you become incapacitated. Once again, an estate plan attorney or a financial advisor can help you set up what's best for your needs. Small steps can enhance your financial life one day at a time. So make sure that you follow the instructions that we have provided for you in this lecture, and make sure that if you have any questions, you contact us to help you. Thank you.